So what we're going to be going over in this very first section is pretty much breaking down what exactly Forex is and what you're going to be trading, and just giving you pretty much the overall fundamentals of what market that you're currently getting yourself into. We have a lot of similarities to the stock market itself, but we're not trading stocks, we're trading currencies. It's a way bigger market. It's a more manipulated market. There's a lot of sharks out here in the market, and you need to be able to protect yourself as best as possible. I don't want to get too much into detail. What I'm going to be simply doing is kind of reading off the slides and pretty much breaking down everything and simplifying everything for you as best as I possibly could. I didn't get a PhD in teaching, but I am very knowledgeable in my industry, and I am very knowledgeable in my craft, and I'm here to help you perfect your trading and help you reach your goals and hopefully get you to the level that I'm at. I do have a lot of successful students. The most remarkable ones off the top of my head is my currently 18-year-old student Chow. He's making a full-time living from his parents' house, making 30 grand a month on a funded account. But let's just kind of keep things simple for now. Again, we're going to go over a lot throughout the entire period of the course. I don't want you to get confused, so let's kind of break things down piece by piece. So what Forex actually is pretty much what we're going to cover. Let me get this out of the way. So what we're going to be covering in today's lesson so far, and again, when you're taking the course itself, I don't want you to kind of just skim through it and take everything and kind of, cram all the information, because you're not really going to learn there. Take your time with this program. You have it, you have lifetime access, you have me, lifetime access, if that's how you want to call it. But I want you to take your time with this program. So what we're pretty much going to be covering in this lesson is, one, understanding what the Forex market actually is. Two, what is traded, what types of currencies there are, and the different currency pairs. So let's kind of get right into it. And then obviously we're going to break down your minor and major and minor currency pairs. So what Forex actually is itself, like I said, again, it isn't like the stock market. But when you actually take a Forex trade, what you're simply doing is you're selling one currency and buying another, or vice versa. You're buying one currency and selling another. So pretty much all it simply is, to kind of break it down as best as possible, what you're doing is, when you buy a currency pair, because you're always trading in pairs, what you're simply doing is you're betting that one currency will go up and the other currency is going to go down, right? You can pretty much think of it as, one currency stronger than the other currency. And if you're correct on your overall hypothesis on the market direction and the direction of that currency pair, you will make a profit. Pretty simple. I'm going to, no, I can't. And that's really all it simply is. So typically, if you've ever traveled, you'll usually find a currency exchange booth at either the airport or areas where there's high tourism. Obviously, this is a smart business move for those people, but pretty much when you're going into a new country, your typical, native country doesn't use that same country's currency. So if I were to go to Canada, I'm sure they accept US dollars there, but what I'm going to be doing at the airport is exchanging any cash that I have with me, any US dollars. I'm going to exchange them for Canadian dollars, and you can do that here at the booth here, where you actually will see an actual screen that has the exchange rate, and that is going to be the exchange rate of both currencies together. But typically you're going to be, again, changing your current currency that you hold from your native country to the other currency. So now, like I was talking about the exchange rates previously, so all an exchange rate really is, it's the relative price of the two currencies from the two different countries. So you can think about it as like the median of the two currencies from those countries, right? It's typically these changes in the exchange rate that allow you to make money in the Forex market. So, if the exchange rate actually increases, let's just say I were to, sell my USD for Canadian dollars, and USD CAD actually goes up and the exchange rate increases. When I go to actually convert my Canadian dollars back to US dollars, I'm going to have, maybe instead of giving me $100, they're going to give me $101, right? And that's if I hold that same amount, right? But now what I want to put is a comparison of what market you're actually getting into here. So we're going to be taking a look at all of the stock markets and then taking a comparison to the Forex market. So currently, as of right now, the Forex market is a $6.6 trillion industry. I just want you to wrap your head around how much money and volume is actually traded. And this is on a day-to-day basis. So if you look at the London Stock Exchange, only $7.2 billion of trading volume. If you look at the Tokyo Stock Exchange, there's only about $18.9 billion worth of trading volume. And then we have the New York Stock Exchange, where there's around $22 billion worth of money that's actually traded in the New York Stock Exchange. Now, if I were to combine and add all the money that's traded in between the London Stock Exchange, the Tokyo Stock Exchange, and the New York Stock Exchange, that still doesn't even compare to how much money is traded here on a daily basis in the Forex market. I'm telling you, this is literally the biggest market that you're getting yourselves into. And like I said, there's going to be lots of sharks, there's lots of whales looking to take your money. So your overall goal in these beginning stages is to preserve your capital as best as possible, right? So now let's kind of go over, obviously, what is traded. We're not trading companies here. We're not trading stocks. We're trading physical currencies themselves. Now, with, the Forex platforms, typically like MetaTrader 5, C-Trader, those are typically like currency pair platforms. You could still trade like stocks, indices, cryptos, depending on the broker that you choose, which we'll go over recommended brokers and everything else later on. But typically, the answer is pretty simple. We're trading currencies here. And, again, with currencies being traded, you're trading a lot larger of a market. So when you're actually trading itself, you can think of buying a currency, or you can think of buying a currency as buying a share in a particular country, just like buying shares of a company, or, buying stocks in general, right? So now let's kind of go over some of the basic currency symbols. So everything is going to be referred to in symbols. There's not going to be, US dollar versus Canadian dollar. Everything is going to be in symbols, especially, when you go on your trading view, which is going to be your platform that you mark up. When you go on your brokerage, MetaTrader 5, MetaTrader 4, whatever the case may be, everything is in symbols. So typically the first symbol is going to be the country name, and then obviously it's going to be the currency name. So NZD is going to be the New Zealand dollar. Very basic. It's very basic understanding here. So now let's go over the major currencies. Obviously, most of us know the major currencies from around the world. So we have USD, the US dollar. We have the euro. It's it's all of Europe. We have the JPY, which typically is going to be in Japan, or we have the yen. But in Forex, we refer to as the yen as the JPY. GBP, we have the Great Britain pound, and it's referred to as a pound. Very, basic analysis here of, how we refer to these different currencies from these different countries. Everything else is going to be referred to as dollar unless you're trading CHF. Now, what exactly is a currency pair? Now, like I said previously, currencies are always traded in pairs. So your first currency is going to be here, like going back to our main screen here. We have the Great Britain pound. We have the GBP. Like I said, everything is referred to almost broken down a little bit. It's not a whole exact word. It's just kind of syllables, right? So we have the base currency pair, which is going to be your first pair here, right? This is always going to be your base currency pair. This is what you're going to see first. This is typically where you're going to be betting this pair against. Right, so we have the base currency pair, or the pair, or the currency you are buying when you actually trade the Forex pair, right? And then we have the quote currency, or the currency that you are selling when you trade the Forex pair. So if I'm going to be trading GBP, JPY, and you perform your technical analysis, and based off your technical analysis, you decide to actually buy GBP, JPY. What you're doing is buying GBP and selling the USD. Now, vice versa, typically there's no USD GBP pair, but if you were to have the USD as the base currency and the quote currency as GBP, again, you can think of base as number one and then, quote as number two, right? You're going to be selling the USD and then buying the GBP if the roles were reversed here. So I hope everybody gets that concept. It's fairly similar. Again, your base currency is the one you're buying, and your quote currency is the one you're going to be selling. So now, what are currency pairs? Breaking it down a little bit more in depth. So the Forex market is always going to be quoted in currency pairs. Like I said, you're never going to just trade a single currency, right? Now, the price for the pair is how much the quote currency costs to buy at the unit of the base currency. I don't want to make things too complicated. So basically all you're simply looking at is, again, is the exchange rate, and the price of the currency pair is what you're looking at, is the exchange rate itself, and it's the median of both currencies combined, right? The base currency and the quote currency. Now, when you're actually trading Forex, like I said, you're buying one and selling the other. And then when it comes down to the actual currency pair and we look at the price, again, this is going to be the exchange rate. And all we're simply going to be doing is looking at this price, and we're going to be referring to our levels and everything off of this price. This is the exchange rate price. Again, the median of both of these currencies quoted. This is where this number comes from. Again, referring back to our initial example of the exchange rate. Now, you're going to have your major currencies, and then you're going to have your minor currency pairs, right? So typically your major currencies are going to be like the US dollar. Your major currencies, you're going to have way more volume, meaning bigger moves. More volume, you could potentially make more money, but keep in mind, more volume, you can also lose more money. So starting off, I recommend you guys maybe try trading the minor currency pairs. You could definitely start off on the major currency pairs, but just know that things happen a lot faster, a lot quicker, and the moves are a lot bigger. So all you simply have to do is adjust your risk. So the major currency pairs are the most liquid in the world. Like I said, there's a lot more volume traded in the major currency pairs versus the minor currency pairs, which means that these will have the most activity, right? The major currency pairs will contain the USD on the side. So Euro USD, in this situation, again, breaking down what I said, base and quote currency pairs, right? Euro in this situation is our base, USD is our quote currency pair, right? In this situation, the USD is our base currency pair and the JPY is our quote currency pair, right? But normally, typically, the currency pairs that have the most volume are going to be the US dollar. Along with that being said, these are also going to be the most manipulated pairs in the market, right? Market manipulation does happen, and typically we see it with the US dollar involved. So you can take a look at the major currency pairs here. Now, your minor currency pairs typically don't contain the US dollar, and typically you're not going to see as much movement in price than your major currency pairs. Even though they are not as frequently traded as the major currency pairs, they are still liquid enough to provide great trading opportunities for you guys. You can still definitely benefit off of them. You can still definitely make a lot of money off of them as well. You're going to have pairs that have a little bit more volatility or volume traded versus, other pairs, right? Now, typically these are going to be your minor currency pairs, which are going to be the Euro Swiss, the Euro GBP, pretty much anything that doesn't have the US dollar involved. Now, that being said, the second most largest traded currency is going to be the Great Britain pound. So GBP, JPY, I would consider that to be a high volatile pound. We can get into all that later on. And then, you have your euro crosses, you have your yen crosses, and then you have your pound crosses. Now, again, trading a pair like GBP USD, is going to be very volatile. Now, hopefully, guys did understand this, the very first section. I didn't want to give you guys an overload of information to complicate things. Now, hopefully, you did take a lot of notes. Again, take your time with the course. And again, you can always reach out to me whenever you have any questions. I don't think this was maybe too complicated, but, definitely we have to go over the basics and the foundation first before we can get into more, the more fun stuff, learning about trading like price action. So I'll talk to everybody in the next section. So what is going on, everybody? Welcome back to another section in the Day Trading Institution program. Now, again, the first section, we're going to try and keep things as simple as possible. We're going to be going over today the fundamentals of Forex and what Forex is. So we're going to be covering a few topics today in today's lesson. So the first thing is what we're going to be doing is covering market distribution. We're going to be understanding what buying and selling is. We're also going to be going over the process of the trade itself, examples of trades, well, not like actual chart examples, but just kind of a few examples of how you can actually profit off of the market. So when we talk about the Forex market and the overall distribution of the currencies that are traded, right? The US dollar is the most traded currency, making up 84.9% of all Forex transactions. And you can see the euro makes up about 39.1. So these are going to typically be your more volatile pairs to trade. So anything that has the USD or the euro. And, typically these are going to be your more manipulated pairs, like I've said previously. So you can see, the USD is something that is traded the most. And then everything else is kind of spread out evenly out of the 100%. Then we have the euro in second place, then the yen at third. So we have these three currencies being traded the most. This is kind of the distribution of the amount of volume that's actually traded. Now, this is important to know because this is going to be how you can determine, where you are at skill level in terms of your reaction times to certain things in the markets, and what pairs you may want to trade. Some pairs may be a little bit riskier to trade because there's more volatility. And when there's more volatility, typically you have to use bigger stop losses and whatever the case might be is. But bigger stop losses also calls for bigger take profits, right? So now let's take a look at why the dollar is, the most traded pair within Forex itself, why the most people actually trade the dollar than Forex. So obviously, one, it is the largest economy in the world in terms of the US dollar. It is also the reserve currency of the world. And then also, along with all of that, it is the largest and most liquid financial, the largest and most liquid financial markets in the world as well. Then also we do have the US dollar now, the US dollar does have a stable political system, military superpower. And then, of course, we do have the cross-border transactions, and that's if Mexico wants to buy, oil from Saudi Arabia, it can only be bought with US dollar. Why is that? Because it is the reserve currency of the world. That is why the dollar is king. So there's typically going to be more news whenever we have big news events going on in the economy. Typically, the US dollar is going to be affected the most. Now, buying versus selling, long versus short, these are going to be basic terminology that we as traders refer to, what positions we're taking within the market. So when you actually trade the Forex market, you can either buy or go long, or you can actually sell or go short on most currency pairs or on all currency pairs. If an individual loses money on a trade, then somebody else basically took their position, because for every single buyer, there has to be a seller. So let's say Juan is buying USD JPY and Joseph is selling USD JPY. Let's say Juan loses money in the markets, and that's because Joseph is actually gaining money in the market. So, both a buyer and seller can't win at the same time, because for every buyer, there actually does have to be a seller. Now, what actually happens when you take an actual trade itself? First, you as a trader are going to execute the trade on your trading platform, whether that be MetaTrader 4, MetaTrader 5, C-Trader, doesn't matter. It's going to go through the broker's dealing desk, because the broker is the one that gives us access to actually trade the markets. They're the ones, that charge a commission for us trading in the markets. And then obviously our order gets put into the actual market. Now let's go a little bit more in depth with this itself. So actually we're going to stay up here. So now let's do a quick breakdown on the broker itself. So when you actually, before you even execute a trade, you as a trader need to be not in contact with the brokerage, but you already know who your brokerage is and who you're going to have your trading capital with. This is going to be the people that are going to give you access to liquidity, to the market itself, so you can actually trade. So when you make money, it goes back in your pocket. When you lose money, it goes back into the bank's pocket or the liquidity's pocket, right? So when you actually execute a trade, this can either go one of two ways. You have the broker that's putting your trade straight through the liquidity provider, or you may actually just be trading with and or against the broker. So we have actually two things in terms of Forex brokers. Well, let's just say this broker, he is an A book broker, a book. And then this broker, let's just say he's a B book broker. Right? So the difference between A book and B book is when a brokerage, now typically, most unregulated brokerages do both. It's not necessarily a bad thing, but you guys need to know this information, right? So when you execute a trade, and depending on if you're an A book broker, right? This example is going to be for the A book broker. When you actually execute a trade in an A book broker, what you're doing is you're placing an order. They're the actual middlemen in this transaction. You're placing an order on their platform, which is an A book brokerage. Now, again, most brokerages do both. Typically, profitable traders will be put in the A book, right? Now, when you actually place your trade, all the brokerage is simply doing is, when your account is under the A book, is they're processing your transaction to the liquidity provider or the bank, and they're charging a commission or they're going to charge their fees, commission, swaps, and spreads. Typically, that's how the brokerage is going to make money through the A book, right? Now, when you actually place a trade, right, and let's keep in mind this guy's the B book, right? When you actually place a trade, and let's say your account is under the B book section, right? Your orders aren't going directly to the liquidity provider, because typically the B book brokerage is going to be the liquidity provider. So you're just placing an order straight to the brokerage. Basically, they're not processing your trade to the liquidity provider. Now, does that mean you can't make money? No, not at all. On the contrary, actually. Typically, when you're trading B book, you're going to have faster execution, less slippage, and things of that nature, because your trade isn't being put into a liquidity provider. And when we talk about liquidity providers, we're talking about the main players in the market. You're talking about HSBC, Citibank, your real big players in the markets, the whales, right? Again, when you're actually in the B book section of things, your trade is going directly to the broker, and you're trading against the broker and the market at this point. But if you make money, the trade goes to you. If you lose money on the trade, right, or the profits go to you. If you lose money on the trade, your money goes to the brokerage, when that's vice versa on the actual A book section of the broker. So we're going to keep this here, right? So when you actually lose money on a trade, and let's say you're trading through the A book section of the brokerage, now you're never going to know if your account's A book or B book. You're never going to know that, right? But when you actually make money on an A book brokerage, the brokerage doesn't lose money because they still made their money on commissions, right? Why? Because your order is processed straight to the liquidity provider or the bank. So if you make money, your money is going to be given to you directly from the liquidity provider in this situation. If you lose money, your money is going to go directly to the liquidity provider in that situation. And with the B book, you could just think about B book as the brokerage being their own bank, their own liquidity provider, right? With A book, you have a bank. With B book, there is no liquidity behind the B book section. Why? Because the brokerage, the brokerage is the bank. Now, again, right, there's going to be A book and B book on all brokerages. Depending on your profitability will determine typically if you go on the A book or the B book section. You guys need to know this, because that's how brokerages also make money. Along with that, they make money through spreads, swaps, and commissions. Now, again, there's two sides of the trade, right? The brokerage being the middleman itself. Your trade is going to be executed to the brokerage, which they will then forward your positions to the liquidity providers, and then they're going to just charge their fee, right? Let's just say this guy's on a completely different brokerage. He's going to execute his trade. The trade is going to go through the dealing desk of the brokerage, which will then process your transaction to the actual liquidity provider. So let's say you make money, you're going to take money away from the liquidity provider, and let's say this guy over here loses money, right? All they're simply doing is moving your money from this guy's pocket right here to your pocket, and vice versa. Same thing. And again, the bank just has a big pool of money or liquidity in theory, right? So fairly simple concept to understand. Now, let me kind of get rid of this right here. Let me get rid of all these drawings, right? So now when we talk about, an example of buying, right? Let's just say we're going to be trading here gold, right? So let's kind of draw a little graph here, right? Let's say we're going to be trading gold. Let's say price is at 1,700, and then at our lows we have, I don't know, let's put it at 1,650, right? Let's say price is doing something like this, bouncing from 1,650 to 1,700. This is just going to be a basic example for you guys, right? So when you actually take a long position here, and this is where you enter the market, and this is current market price here, right? As price goes in your favor and you're long, all you're simply going to be doing is you're going to be making money, meaning your account balance will have an open equity that is positive, that is in the money, right? And let's say you want to close your position here. So let's say you bought in here at 5 lots, meaning you're making $5 a pip, right? And let's say this price range difference is 50 pips. So if you're making $5 a pip, and we can get into the more dynamics. We will get into the more dynamics of, what is a pip and everything else later on. But if the market goes up 50 pips in your favor because you bought and the value of gold went up from 1650 to 1700, then all you're simply going to be doing is making a $2,500 gain. So now the same thing goes for when you're actually going to be selling, right? So let's say you decide to actually take a sell position, which honestly, what I'm going to do here is just simply move this down, right? Now, let's say you're going to be taking a sell position at 1700 here, right? Let's say, again, the chart looks exactly the same, but you decide to take a sell position here for whatever reason you choose to take that sell position, whatever your logic behind the trade is. If you enter your short position right here where I drew this line, right, let's say at 1699, right, and price goes in your favor, meaning price is dropping, and now it's trading at 1650 for 5 lots, and the market dropped 50 points, right, you're going to be in profit roughly $2,500. Now, determining what lot size you're going to be using is all based off your account balance, but I kind of want to keep things a little bit simple for now. Just kind of wanted to give you guys an example, buying and selling, how you can actually profit. And hopefully you guys did understand this. Hopefully this wasn't too complicated for you guys. But anyways, if you guys ever again have any questions, feel free to reach out to me, be active in the community Discord, and a lot of people will help you out. So hopefully you did understand this, and I'll talk to everybody in the next section. Yo, what's good, everybody? Welcome back to another section in the Day Trading Institution course. So the first things first, I want you guys to take everything lesson by lesson. Take your time, really try and soak in all the information possible. Even if you finish later on, I want you guys to kind of come back because you could probably pick up on things that I missed up before. So anyways, in today's lesson, what we're going to be going over are pretty much the principles of trading. So what we're going to pretty much cover in this lesson is how you can implement a casino-like strategy, how to find your winning edge, looking at the probabilistic side of trading along with managing your trades. So anyways, most of you guys are probably familiar with what a casino, I'm sure, everybody is familiar with what a casino is. But what we're going to be going over is how you could trade as similar to a casino as possible. Now, I don't want anybody to skip through any portion of the course because all these analogies are super important. So later on, they could start to click in terms of, what we can all do together in this learning process on how we can actually apply everything that I'm teaching you guys. So when I talk about trade like a casino, I don't literally mean trade as if you're an actual casino. What I mean by this is all we're simply going to be doing is looking for the probability and understanding what probabilities actually are, because trading is not a game of 50-50, even though there's either buy or sell, because there are probabilities and there are certain things that do come into account when we're actually looking to trade. So everybody knows what a casino is. Everybody is probably familiar with what this table is, which is going to be roulette. So now, first things first, as you can see, the casino automatically has an edge over their gamblers. Now, you want to think about trading as gambling and you want to be the actual casino. So you have to ask yourself, how can I be the actual casino and how can I adopt this mindset? How can I apply this to my trading, right? So you being an actual casino, then everybody else in the market is a gambler, because we know the statistic that 90% of people within the market fail. Why? And that's just because mainly due to gambling. A lot of people can't seem to find the discipline and are really trying to get rich quick. And that's very similar to what the casinos are. A lot of people probably say casinos are a quick way to get rich, right? But now what we automatically have with this table in roulette, now I'm pretty sure, most people when they look at this table, they probably have the impression that this is a 50-50% chance of winning, 50-50% chance of losing, which is obviously not the case. Now, how the casino built their edge, where they have an increased edge of about, let's just say 5.2% over their gamblers, is by simply adding this green here. Now, the payout is a 1-to-1 per se. Let's say you were going to bet on black and black actually hits, you get paid out a 1-to-1. You were bet on red and red actually hits, you get paid out a 1-to-1. Now, the issue comes for the gambler is that they don't have a winning edge as of right now. It's not even a 50-50. The gambler's probability is a 47.4% chance of actually winning. Why? And that's simply because of this green color right here. The casinos obviously added this color because they would be probably broke or losing a lot of money due to it being a 50-50. So the casinos ask themselves, how can we have an increased edge over our gamblers? And it's simple, by adding the green color into the scheme. Now, obviously, green doesn't pay out a 1-to-1. I believe it pays out like a 1-to-7, 1-to-14, something like that, right? But we're not here to learn about roulette. Anyways, so now if we take a look at things, right, first things first, we have black. So there's going to be 18 black, there's 18 red, and there's 2 green, right? So if you were to look to make a bet, and let's say you wanted to bet on black, the casino doesn't have a 50-50. You don't have a 50-50 chance of winning because the casino has 2 more chances of beating you here. So if it doesn't land on red and it doesn't land on green, then that's when you would win. But notice that the casino has 2 chances to actually beat you here versus you only have 1 chance no matter what you bet on, right? And that's just how the casinos built their edge. They're always going to have an edge over their gamblers. Now, obviously, the gamblers get lucky, right? And they may actually, hit whatever they were betting on, but the casino's always going to have that 5% edge, keeping them profitable in the longer run. Now, let's move on to the next subject, right? So when it comes down to trading, trading is all a game of probabilities. You never want to associate trading in the words like 1,000% or 100%, along with, I know the market will do this, or I know the market will do this and then do that. You never really know. You want to adopt the mindset that you don't know what the market is going to do, and we're only trading based off of probabilities. And keep in mind, probabilities will never be 100% correct. You're never going to be 100% correct in the market. Now, there may be times where you may feel this way, and especially when you're in a winning streak, your confidence is very high. So what tends to actually happen is traders at this point in time will start heavily increasing their position size, and then they start getting a little bit of losing streaks, right? Or they start entering a little losing streak. They lost 2 trades in a row. They'd be like, all right, you know what? I'm actually going to double up on this trade because I'm pretty sure I'm going to win this one. Typically tend to lose when that's not the case. We want to be able to manage our risk and really understand that trading is actually just a probabilistic game, and we have to approach it with this probability mindset that you're not going to win every single trade. You're going to learn patterns and everything later on throughout the course, but just because you see these patterns, it doesn't mean it will 100% play out. Now, again, you have a higher probability, right? You as a trader need to determine what your high probability setups are versus what a low probability setup is, and then manage your risk accordingly. On your high probability setups, you probably want to use a heavier position size than when you have a low probability setup, because again, the odds are more in your favor for it to play out. But just because the odds are more in your favor for it to play out doesn't mean it will. Just like the casino has a 5% edge over their gamblers, it doesn't mean that the casino is always going to win every single time. They're going to have that loss eventually, right? So your job as a trader is to determine if a trade will actually be or will actually have a high probability based on X, Y, Z reason, which those reasons we're going to get into later on throughout the course. But we're going to be determining things such as price action, indicators, news events, whatever the case might be. Is again, your job as a trader is to determine if that trade has a probability that is higher of the trade actually playing out in your favor. And this is something that's determined by your own technical analysis. And, you can obviously add things later on, like if you want to add fundamental analysis, but typically we're going to be looking at this and we're going to be basing our probability based off of our own technical analysis and what we see that could play out in the market. Now, again, one thing I really want to emphasize is just because the probability is in your favor on that specific trade doesn't mean that you're going to win that trade. This is why risk management and practicing risk management is so important, because this is what's going to keep you alive during the losing streaks. You don't know how big of a losing streak you're going to have. You could lose 6, 7, 8 trades in a row. Again, winning streaks and losing streaks, they come in waves, right? So you're going to have a wave of winning streaks that may be 5, 6, 7, 8 trades that you win in a row, but then maybe, you lose 4 or 5 trades in a row, then you win another 8 trades in a row. And it's literally an entire trend. Like if I could just draw it out for you, having a winning streak and a losing streak will literally look like this, right? And this will be your winning streak right here. And then your losing streak would come in and start to diminish some of these profits before you have another winning streak, right? Let me draw that a little bit smaller. So let's just say that this is your actual winning streak right here. This entire equity in your P, or this entire equity curve in your P&L is what your winning streak is. And then your losing streak looks something like this, right? And then obviously we play the long-term game, right? So this is what your equity curve may end up looking like over a period of trades. Right now, I'm not saying 10 trades, I'm not saying 20 trades, I'm talking about hundreds of trades. That was what your equity curve will look like. There will be hard times in trading and there will be amazing times in trading, right? Trading is something that is really going to test your emotions and really test your psychology, because you need to be able to show up to the market every single day, no matter how many trades you've lost in a row, and complete your technical analysis to the best of your ability, to your peak performance. And there's going to be days where you're not going to be able to perform like you performed, the last few days. Maybe you're a little bit burnt out. Maybe, you have a lot of problems going on in your life that you're a little bit stressed, and that's going to affect your trading. There's a lot of outside stressors that will definitely affect your trading, but you got to keep you got to keep the overall picture in mind that you're playing the long-term game here. This is how you're going to be able to survive this through risk management. Now, don't keep me wrong, trading could be a lot of fun, especially, when you're making a lot of money, you're going to be excited to show up to the market every day. But then, at the same time, when it starts going bad, trading could definitely turn into something that's very stressful. You may have a lot of stress, you may have a lot of anxiety. Again, we're humans and we all go through these emotions, and, money is a very sensitive topic for, I want to say, the majority of people, right? A lot of people make decisions, poor ones and good ones, based off of money. And these are just, the side effects, I guess, of being a trader. I don't really want to say the side effects, but, that's just in your job description. You have to be able to hold yourself accountable, because I'm not going to hold you accountable if I say, hey, you're trading like you're gambling, right? I can't hold you accountable to that. You have to hold yourself accountable to that. But just understand that, you will have losing trades. Just don't let those losing trades discourage you. Like I've always said, the only traders I fail are the ones that quit. Right? Now, let's go over an example of what a high probability trade actually looks like here. So what I'm gonna do, let me try and figure out how I'm gonna plan this out here. So what I'm gonna do is I'm gonna draw some fake market structure here, right? Okay, so now I'm not gonna get too in depth here, because we haven't really even gone over market structure or anything. But what I'm gonna simply be doing is talking based off of price levels. So let's actually kind of take some time to do this drawing here. So what I'm gonna do is I'm gonna draw one level. Let's just leave it right here. Right, actually, let's undo that. What I'm gonna do is I'm gonna draw a level here. I'm gonna draw a level here. Right. And let's just say, let me just kind of continue this here. Right. So now what I'm going to do is put this here, and let's just say we're trading gold again. I'm just going to use gold as an example because that's the currency pair that I trade the most. Let's say it's 1800. Let's say this is 1750. And then let's say this up here is 1850. So now let's say that you're taking a position here, and you've seen time and time again, whenever price hits this line here, 1800, whenever you see price or the market hit this 1800 line, it completely rejects and moves in the opposite direction. You're looking at previous market structure, and you see that there is a level of supply and demand here. Now, again, the market moves based off of supply and demand, and market moves off of volume. So already, right? Trading is based off of supply and demand and based off of volume, right? So you determined already that every time prices hit this level, it's rejected and moved in the opposite direction previously. Notice how here it rejected and went down. It rejected here and went down. It rejected here and went up and rejected here so far. Now it's going down. So you make the hypothesis, okay, well, if price is actually trading at 1800 now, right, and we've actually broken under this level of structure and we've started trading lower, what's the probability of price to continue to go down versus to continue to go up? Now, I'm not really adding in here any other factors such as, candlestick analysis. I'm not adding into any other factors, maybe such as Fibonacci, or I'm not adding into, indicators, but you want to look at all those things, right? Let's say your indicators are also telling you sell. You have already 3 things that are telling you to sell. One of your indicators is telling you that no, there's a higher probability of price is going to go short right now. You have a level of supply and demand, and you have the multiple rejections already. This is a major level of structure. So you've already identified that you're going to want to go short because the probability of price to continue to go down is a lot higher. Now you have to actually map out your actual trade. Now that you know you want to go short, you have to tell yourself, okay, where am I going to get out if I'm wrong? And that's something that you have to identify before you actually enter the trade. Let's just say you've identified that you want to get out at this price right here, 1852 is where you're going to cut your loss. Because again, we're going to be wrong, right? So if price actually does come up to 1852 after your entry point, let's say you took an entry right here where this red mark is, if price does come up to 1852, you've already identified that you're wrong on that trading. When you want to cut your loss short, you're going to cut it right there and there at 1852. Now you have to ask yourself, okay, where am I going to get out if I'm right? And that's going to be 1750. Why? Because every time price came down near 1750, it had some consolidation, or it decided to actually reject and move the opposite direction. So that's where you want to get out and take your profits when you're actually right. And, I can, look at things like I can incorporate risk management, I can incorporate risk reward, but I just kind of want you to identify or really take an example of what a high probability trade looks like. We have multiple confirmations that price is most likely going to go in our favor. We're simply just going to wait for our entry point. Once price actually gives us our actual entry, we're going to take the trade. And it's as simple as that. You're not taking trades for no reasons. You want to have an if and then thought process. Well, if price can reject 1850, then I'm going to be looking for price to reach 1750 and trade lower. Now you have to ask yourselves, why is that? You always want to ask yourself, why do you think that price is going to continue to go lower? Well, market structure has actually broken to the downside. We've pulled back to a previous level of supply and demand, and price held as resistance. It's as simple as that. What you've done for yourself is you've built yourself a high probability trading setup. And again, you can incorporate things like the trend and everything else. But really, I kind of just want to keep it simple as of right now. So anyways, hopefully you guys did really understand this section. This is definitely a video that you can come back to in the future. That'll definitely help you guys out a lot once you get a better comprehension of what trends and market structure and everything actually is. And hopefully you guys are benefiting off of this as well. And I'll speak to everybody in the next section of the course. What's going on, everybody? Welcome back to another section here at the Day Trading Institution. So again, taking it step by step, I really want you guys to kind of have a good understanding of the basics. So in this section, all we're simply going to be doing now is pretty much going over the anatomy of trading. Now, in this lesson, what we're going to cover is our role as traders and kind of, what it is to be a day trader or a swing trader or a scalper, whatever type of trading form you decide to go with. A breakdown of an actual trade. Now, not necessarily, me going on the charts and actually breaking down a trade, but a breakdown of the process of a trade and how you can actually make money in this market. The simple math behind a trade, what causes price to move, and the different types of trading. So now let's kind of get into what our role as traders are. So our role as a trader is simply we are going to be looking to buy or sell a currency pair to capitalize on the daily movement, on the daily volatility. Every single day we have trading sessions. Within those trading sessions, there's going to be more movement in the market. That's going to cause a fluctuation in the exchange rate, and we're simply looking to capitalize off of that fluctuation on the exchange rate. That's as simple as it is, right? Now let's go over the breakdown of a trade. So let's say you're going to be trading the currency pair GBP USD, which again, let's go back to the basics. GBP is going to be our base currency So the USD is going to be our quote currency, right? And now GBP USD is, let's say, is trading at 1.21, which is the current exchange rate, right? 1.21, let's just say, is the current price between the bid and the ask of the exchange rate that the brokers are going to be selling to us. Now, let's actually break down a trade. So you really have only two options here. So option one to trade GBP USD at 1.21 is you can either buy the base currency if you believe the base currency will appreciate in price relative to the quote currency. So if you see GBP USD actually going from 1.21 to 1.25, let's just say, then typically you're going to be looking to go long or buy, right? Now, your second option is to either go short or sell, which theoretically in this situation, you would be looking to sell the base currency GBP if you think the base currency will depreciate or lose value relative to the quote currency. So if you think that GBP is going to be going down and the USD is going to be going up, then we're going to be selling the at 1.21, which is the current exchange rate, because again, our base currency is going to be really what we're looking at in terms of price here. So if you see GBP USD, or if you see the GBP going down and you see the dollar looking to potentially rise against the GBP, then we're going to be looking to go short. Now, let's just take it one step further, right? So now, how do we exactly use this exchange rate? So on the actual chart, you're going to see obviously the candlestick chart, and then you're going to see price on the side. We're going to be looking to mark off our levels. Let's say we're looking to take a buy, and we're looking to take price to 125. If you think price is going to go to 120 or 1.25, then you're simply going to be going long. If you think price is going to go to 1.15, then you're simply going to be going short. So all the exchange rate tells us is how much money you have to pay in units in terms of the quote currency, because everything works off of units. And then, to simplify things, it's going to be into lot size. So in order to buy 1 unit of the base currency, right, you have to pay 1.21 US dollars to buy 1 British pound if you're going to be going long. And again, this is the base currency. So again, to buy 1 British pound, we have to pay 1.21 US dollars. And that's done through units and lot sizes. So now what if you're actually looking to go short? Again, it's the same thing. In simple terms, you will receive 1.21 US dollars when you sell 1 British pound. It's as simple as that. So now let's look at the actual math behind the trade. So we're going to have your action here being the trader, and then we have our base and our quote currency. Remember, the base is GBP and the quote is USD. So we're pretty much going to be trading GBP here. So let's say you're going to be looking for the exchange rate to actually go up, meaning you're going to be looking for the Great Britain pound to rise against the US dollar. And let's just say the current exchange rate is going to be 1.21. Now let's say you buy 10,000 pounds of GBP USD at the exchange rate of 1.21. So you buy 10,000 pounds and you're going to multiply that by the current exchange rate at 1.21, and that trade is going to cost you 12,100 US dollars. Now, let's say 2 weeks go by, because remember, we're looking to buy because you thought the exchange rate or your trading hypothesis told you that the exchange rate is going to increase in price. Now, let's say 2 weeks go by and you exchange your 10,000 pounds back into US dollars at the exchange rate of 1.27. Remember, the exchange rate is the current trading price. Now, again, you still have 10,000 pounds. Even though you bought for $12,000, you bought 10,000 pounds. Now, since the exchange rate has actually gone up and increased in value, we're now going to multiply our 10,000 pounds by 1.27, leaving us at $12,700. And we've made roughly around a $600 profit in total. And that's the basic math behind a trade. So what actually makes price fluctuate? Now, what actually makes price fluctuate, and the only reason price moves, is all simply based off of supply and demand. It's as simple as, let's just say a pair of Jordans are on sale let's just say there was a total of 100 new pair of Jordans for sale, and each Jordan was going to be selling at $100. Let's just say you bought a bulk discounted price, because typically in a trade you're going to wait for price to pull back. In pullbacks, or what we call discounts, right? Let's just say you bought 80% of the value of, or 80% of the actual Jordans that are available in the market, and your now new Jordans that were typically going to be $100 per shoe. Let's say you bought it at $90, whatever the case might be, is right. Now, all you simply did is you bought 80% of the supply of those Jordans, and now there's going to be a higher demand for those Jordans because you as a sole individual had bought the majority of the shoes that are on the market. So now there's less shoes available in the market, and the demand for the shoe actually increases. So now let's just say, since the demand of the shoe actually went up in value, right, those Jordans cost $150. Now, if you were to sell, again, every single Jordan you bought, 80% of them for $150 because they were retailing at $100, right, you're going to make a $50 profit on each of the shoes that you ended up purchasing, or technically a $60 profit if you got the shoes at a 10% discount. So you're making $60 on top of every single shoe that you purchase, and that's how basic supply and demand works. So the more demand that there is for something, in this case the shoe, because you bought most of the shoes that were available in the market, again 80%, the demand is going to significantly increase, right? Now when there's more supply of the shoes, meaning that you're going to put 80% of those shoes back on the market, the supply is going to decrease after you've already sold all of the shoes that you've previously owned. So less demand equals a price decrease, and then less supply equals an increase of price. And this is simple, basic supply and demand, and this is the only reason the market moves, is because of supply and demand, right? Now, you could take into account fundamentals and everything else, but that's just basic supply and demand, right? Let's just go over that. That's the main reason why the market moves. Now, there's two different types of tradings. You have to identify what type of trading suits your personality. Are you somebody that's more patient? You can hold your trades for a little bit longer. You can wait for things to play out a little bit longer. You know, maybe are you a little bit of a slow reader? And this is not to make fun of anybody, but not everybody's going to have the capabilities to make decisions on the fly like a scalper is. And this is something you're only going to be experiencing with time. I'm here to just expose to you the different types of trading that there is. So day trading is pretty simple. When it comes down to day trading, and me personally, I could do day trading and swing trading because I'm a little bit more of a patient person. And to be honest, you know, you're going to catch way bigger moves day trading and swing trading. So when you're buying or selling within the same day is day trading. When you're typically buying within the same daily candlestick, when you're typically buying and selling within the same trading day. So from 5 p.m. to 5 p.m., that 24-hour time span is typically a day trader, right? Your position is going to be closed out within the same day that they're taken. No positions are going to be held overnight. Like I said, I can do both. Typically, most day traders can also swing trade as well. Now, swing trading, when it comes down to swing trading, trades are held for more than a day, meaning that your position will take a few days to actually play out, and your position is closed within a few days, maybe even a few weeks. Now, you know, once we start holding trades for a few weeks on end, we're typically talking about position traders, which are pretty much a borderline investor at that point in time. And then the last form of day trading is going to be scalping. So pretty much it's the quickest strategy used by active traders. Trading when you're actually scalping, you're looking to get out of the market, you know, you're looking to get out of the market pretty much in and out within the same hour even, right? So when you take advantage of small moves that occur with a frequently larger position size, meaning that day traders may use smaller position sizing, but again, the moves that day trader catches are a lot bigger because of the fact that, you know, we're holding these positions. We're looking for those big swings. Scalpers are typically just, you know, in and out within the first few minutes, you know, to an hour. You know, past that, you'd probably be in the day trading range. And that's fairly much it. You know, typically when you're scalping, you're going to be using smaller time frames and you're going to be getting in and out. This is going to require you to actively monitor your positions, where if you're a day trader, you don't really have to actively monitor it. You can kind of just, you know, enter your positions, set your stop loss level, set your take profit level, and monitor your position throughout the day. Scalping, you literally have to sit on your desk, full focus, 110%, and, you know, you're in and out within, you know, the same trading period, the same few candlesticks. You're in and out within, you know, the same hour. Your trading day is a lot quicker. But again, it requires you to be at your desk. So if you're somebody that has a full-time job, if you're somebody who can't, you can't dedicate 5 hours of your day to just sitting on your computer, then, you may want to look at day trading or swing trading into an alternative for you. If you're somebody who likes to take your time and make these decisions, day trading is definitely the better alternative for you. Again, there's pros and cons throughout all of them. Later on throughout the course, we're gonna go over these pros and cons so you can make a better decision for yourself in terms of, when we're creating your trading plan. But anyways, I again want to keep things simple, and I will see you guys in the next lesson. Everybody, welcome back to another section here at the Day Trading Institution. So pretty much what we're going to be going over today is trading terminology. So this is still like the beginner stuff, but we're starting to get out of the beginner section, which is an important section, but it's the most tedious one to learn because we're getting down into like the foundation of what Forex trading actually is. So what we're going to be learning in this lesson is we're going to be pretty much covering what a pip is, what lot sizes are, what the bid price is, what the ask price is, along with what the bid-ask spread is. We're also going to be going over what a quote conversion or convention is, what a transaction cost is, and last but not least, what a cross currency is. So what is a pip? So you're going to hear me refer to a lot of these terms throughout the course. So what a pip is, it's pretty much a unit of measurement used to express a change in value of a currency pair. So when we talk about pips, right, we're really going to be referring to how much a specific currency pair has actually moved. So you may hear me say in one of the videos, hey, gold dropped 50 pips, and that's how we measure the move and determine how big of a move it actually was. So let me kind of go back here before I skip on too much, right? So if you guys could actually see, so I mean, it really depends on the brokers too, but really this is how the normal market is, normal exchange rate. So we pretty much are only moving one decimal over, and that's going to be our pip count. So if we start here, this is going to be 8 pips. So if the market goes from 8 to 10, then we know that's going to be 10 pips, right? But if the market goes from 8 to 10, this is going to reset back to 0, and this will be 4. So this will be 40 pips, right? So anyways, this is going to be 8 pips. This is going to be 30 pips. This is going to be 500 pips. So let's say the market went from 538 to 540. The market's gone up 2 pips, and this will be 500 flat, or this will be 500 flat, right? But we'll get into that a little bit more in detail later on, right? So now let's go over an example of what an actual pip is. So if GBP USD moves from 1.1050 to 1.1051, then the 0.01 USD rise in value is going to be 1 pip. So if price went from 1.1050 to 1.1051, that's going to be a 1 pip difference. So the market went up 1 pip. Now, here's another way to actually understand it. If you notice, most currency pairs go out of a 4 decimal place, right? However, there are some expectations like the JPY or the Japanese yen, in which they only go in 2 decimal places. Now, again, this is going to depend on the broker. Sometimes, well, most brokers are going to offer your pipette is typically what it's called, which is going to be your micro pip. So it'll have 3 decimal places, but really only it normally has 2 decimal places, right? So a pipette, exactly what I was just talking about. In simple terms, some brokers might quote currency pairs to the 5th decimal place, which almost all brokers quote currency pairs to the 5th decimal place, as you can see here, right? Now, how do we calculate the value of a pip? So let's take this example. Let's say the exchange rate for USD CAD is going to be 1.0200, right? To be read as $1 US to 1.0200 Canadian dollars, or 1 USD for 1.0200 CAD, right? All you simply have to do is divide 1 pip, usually 0.0001, by the current exchange rate pip, which is the pip value in terms of the base currency. Now, I don't want you guys to really kind of, overcomplicate this. I want to break this down for you guys so you guys will always have the formula, and you guys can always go back, reread the slides, rewatch the videos, right? So in simple terms, if we grab the current exchange rate and divide it by 1 pip, right, it'll give us 0.00009804. So if we traded 10,000 units of USD CAD at the current exchange rate being 1.0200, right? Now, if we do 10,000 units times 0.00009804 USD per unit, which is going to cost us 98 cents, right? That's what we're going to be quoted, right? Meaning 1 pip change to the exchange rate would be 98 cents to the dollar. Now, just a quick reminder, just focus on understanding the idea and principle of these terms. Don't try and actually memorize it and overly focusing on the definition. I just want you guys to understand why certain things are they are. But in terms of reading pips and calculating pips, you don't have to do the complicated mathematical equations. Even though I do want to put it on here just so you guys have an understanding on how you can do it and go about it this way. There are going to be a lot of, again, in our programs, which we'll cover in the next section, I'll cover how to use the pip calculator, along with, actually measuring how many pips the market has moved and everything else. There's literally indicators that tell you how much the market has moved and everything. So don't try and just understand everything to the exact definition, but just get the idea and the principle of these terms. Now, what are lots? Lot sizes are pretty much going to quote us on how much money we're actually buying into the market or selling the market. So lots are the number of currency units you will buy or sell. When you place orders on your trading platform, orders are placed in orders are placed in sizes quoted in lots. Now, here is a chart, a lot size chart, basically on how much you will make per pip. So when we actually press that buy or sell button, we're going to be entering lots. We're not going to be entering the unit, but we're going to be entering lot sizes. We're going to be entering the volume here, right? So if we look at the volume, these are going to be the lot sizes. These are just the definitions of the lots. But let's take a look at the nano lot. Typically, most brokers don't offer nano lots, so I'm not really going to go over it too much. But what they'll do offer is micro lots. So, depending on what lot size you're going to use is all dependent on your account and how much money you're looking to risk along with how much money you're looking to make. Obviously, the bigger the lot size you use, the more you're going to be risking and then the more you're potentially willing to make. Now, when it comes down to micro lots, a micro lot is pretty much where you're buying 1,000 units worth of whatever currency you're looking at. And when you actually place it in your MetaTrader 4, it's going to be a 0.01 lot. So a 0.01 lot translates to about 10 cents per pip. So if the market goes up 10 pips, you've made $1 because you bought in at 10 cents per pip. Same thing with the mini lot. The mini lot, you're actually going to be buying 10,000 units, right? So that is going to be a lot size of 0.10, which means you're going to be making around $1 per pip. So if you buy Euro USD and the market goes up 10 pips, you've successfully just made $10 because you used a 0.10 lot, meaning you're making $1 per pip, right? Now, the standard lot size, pretty much, the lot size you want to throw as a beginner. Well, not want to throw as a beginner, but that's typically like the beginner's goals. I want to do 1 lots because you can make a pretty decent amount of money using 1 lots. So with a standard lot size, you're pretty much buying 100,000 units, which is going to be a 1.00 lots, meaning you're making $10 per pip. So if the market goes up 10 pips and you bought Euro USD and the market goes up 10 pips, you've just successfully made $100. Now, obviously, we're going to go over it, in more detail, everything later on, the actual chart, how you can actually make money. But this is the things that you need to learn. And little by little, just take it little by little, as time goes on and you actually start trading more and more, you'll start getting the concepts better. Again, everything in trading is all based off of experience. You may not understand, how lot sizes work and everything at first, but, as you play around with a demo account and you start to learn things, everything is experience. You'll get the hang of it. I promise you that. So don't get overwhelmed, especially not in the beginning section, right? Now, let's look at an example here. Let's assume we will be using a 100,000 unit standard lot size, meaning we're using a 1 lot, right? And also one thing before I continue, right? There's 10 lots, 50 lots, 60 lots, 70 lots. Remember, one lot is $10 per pip. So if I'm doing 10 lots or a million units, right, then I'm making $100 per pip. So if the market moves up 100 pips, right, I just made $10,000, right? So again, there's, 0.01 lots all the way up to, 1,000 lot, 2,000 lot. Again, it depends how much money you have in your account and everything else. You can do 500 lots, 600 lots, where you're risking, $6,000 per pip. It's all about levels and slowly looking to level up. You're not going to be able to do 10 lots, right off the bat on your first trading account. More than likely, you're going to blow the account. And just remember, right, when you enter, let's just say 10 lots, right, and you have a $10,000 account or whatever the case might be, even though 10 lots for a $10,000 account is a lot, right, you're probably going to have to go through the experience of, losing a lot of money very quickly so you can overcome that psychological barrier. So as there's levels in trading, you're going to have a lot of psychological barriers that you're going to have to overcome. And if you're somebody like me, where I tell you, hey, don't enter 10 lots on a $1,000 account, but you're like, whatever, I'm going to do it anyways because I'm probably right on this trade, and you blow your account, and you have to experience the pain to not do that mistake again, then you're probably going to lose quite a few in the beginning. But just keep in mind, like, the emotions when you actually place that trade. When you see that you place your first lot size on, let's just say, in a $2,000 account, and price goes against you 25 pips and you're down $250 already, you're going to be panicking, freaking out. So just know that everything is a process and don't rush it. You will increase your lot size over time as your account balance starts to increase, and as your skill level starts to increase as well. Right, so let's just go back to this example. Now, USD JPY is trading at the current exchange rate of 1.19 or 119.80, right? And at a 0.01 at the current exchange rate, 119.80, at 100,000 unit standard lot size, that's going to be making us $8.43 per pip. Now, again, depending on what you're trading, the value of the lot size changes. The lowest it'll be is $8.43. The highest it'll be is probably $10, right? But it's around an average. So this is going to be 1 pip. This is going to be the exchange rate. Your lot size is here. This is how much you're making per lot. So all you have to do is all this does is simply calculates the value of the pip. Now, if you notice, a 0.01 has 2 decimal places, right? Now, if you ask yourself why, that's because you're trading the yen. Typically, when you trade the yen, it has 3 decimal places because all brokers offer the pipette, so it'll be worth $10 per pip. Now, let's look at another example without the JPY. Let's assume you're using 1 lot on USD CHF, which is another one of those pairs, right? Another one of those slower moving pairs, right? So we have a 1.4555 being the exchange rate. Now we add that extra decimal place. That's going to be $6.87 per pip, right? So you can also think about it this way: the more popular the pair is, being one of the major pairs, the more value that lot size is going to cost you, or that lot size is going to hold, because there's more volume in the market, right? So that has 4 decimal places. Now again, don't worry. You don't have to sit there and do the math for every single trade. The broker does all the calculations for you. In terms of stop loss placements, take profit placements, and everything else. I just wanted you to understand the math and principle behind all of this. Now, what is the bid price? The bid is the price at which the market is prepared to buy a specific currency pair in the Forex market. At this price, the trader can sell the base currency. So the broker is going to offer you a bid and an ask price. Those are the prices you're going to actually get in at. So let's just say gold is trading at 1,800, right? The broker may, if you want to sell gold, the broker may actually put the bid price not at 1,800, but at 1,801, right? And that 10 pip difference is going to be the spread. The spread is the difference between the bid and the ask price. That's another way that the brokerage makes their money, right? Which, depending on the brokerage, they might have bigger spreads or they might have lower spreads. There's lots of different account types and account sizes. But typically you want to use a brokerage that has a little bit higher commission, meaning they charge you $7 per lot size, let's just say, which is pretty average, or it's pretty low. But the spread is a lot smaller, right? Now, this is going to be the bid price. The bid price is going to depend on the base currency, and then we have the pip value here. So notice how this is a 2 pip difference, right? So the ask offer price is the price at which the market is prepared to sell a specific currency in the Forex market. At this price, you can buy the base currency, right? So here's the ask price, and then notice a bid. Now the bid ask spread, this is the bid ask price that I was telling you about. This is where the brokerage makes their money, right? So notice how the spread is the difference between the bid and the ask price. So this is the bid price, 1.1051. This is the ask price, 1.1053. Right now, again, look at the pip. Look at the last value here of the decimal place, 1 and 3. Notice how there's a 2 number difference. If we take 3, subtract it by 1, we're going to have 2. This means our actual spread is going to be 2 pips. So the broker is going to put us at a 2 pip difference when we actually take the trade, and this is how they make their money. Now, what is a quote conversion? The exchange rates in the Forex market are expressed using the following format: base currency, quote currency, and then the bid and ask price. Now, what is a transaction cost, right? This is going to be the spread. This is where the broker makes their money again. In the case of Euro USD being at the exchange rate of 1.2812 and 1.2815, the transaction cost is 3 pips. The transaction cost is the spread, which equals the ask price minus the bid price. Now, what is a cross currency, right? Pretty simple. Again, that's just how the brokerage makes their money, all throughout spread. What is a cross currency? A cross currency is any currency pair in which neither the currency is the US dollar. Usually cross currency pairs carry a higher transaction cost. What they mean by this, or what I mean by this, is pretty much that if you're not trading one of the popular pairs that offer the US dollar, then they're going to have a higher spread and a higher commission because there's less volume traded within that currency pair. Now, typically in Forex, the more popular a currency pair is to trade, the more manipulated that currency pair is going to be. And of course, big banks, hedge funds, institutions manipulate price sometimes to make extra money. It's like a here and there type of thing where they do price manipulations, right? And it's not something that you really have to be worried about, but just know once in a while, if you ever get taken out of the trade early and then you see price move in your favor, that's simply because market has been manipulated to hit the majority of the stop losses that we place. And then the institutions take price in the favor that price was normally going to go. This is how they make their money. So if you tend to trade less popular pairs that don't involve the US dollar, then you're going to find there's going to be less manipulation. And once again, don't try and memorize everything. A good rule of thumb is just to simply make sure you understand the basic idea of how all these terms work together. It's literally as simple as that. Like I said previously, I don't want you guys to just overcomplicate things. As time goes on, you will understand these concepts better and better, and actually applying them to the chart, like learning how much the market is moving, how much the market has moved yesterday. Let's just say yesterday the market moved 100 pips, and you're expecting another 100 pip move today. Again, everything is trading, and everything is experience in trading. And one thing I've always told my students is that any trader that actually stays to it and will only I don't know why I'm getting like whatever. Point is, right, what I was going to say is the only traders that fail are the ones that quit. So just stay to it. Don't give up. Again, this is just the beginning section of things, right? Things will start getting a lot more simpler as time goes on. You actually become a more experienced trader. And that's really all we wanted to cover today. Again, in the next section, I'll show you everything else on how to calculate pips and your lot sizes and how to enter your lot sizes and everything else. So talk to you guys in the next section. What's going on, everybody? Welcome back to another video in the Day Trading Institution. Hopefully you guys have been enjoying the program so far. Now in this video, what we're going to be covering are the trading sessions. It's going to be important to learn about the trading sessions because this is where there's going to be volume in the market, and we're going to try and go in depth as possible when it comes to during the trading sessions and learning about each and every section. In the next video, we're going to be going over what session you should trade as the trader. So let's learn about the sessions first and learn which one suits you the best. Now, in this lesson, we're pretty much just going to be covering the 4 major trading sessions. Get ready to take a lot of notes. You actually can slow down the video if maybe I'm talking a little bit too fast. But let's kind of get right into it. I don't want you guys to feel like overwhelmed again. These are just very simple concepts. So when can you trade, right? So you can actually trade the Forex market. The Forex market is open 24 hours a day. Does that mean you should be trading 24 hours a day? No. It doesn't mean you should be trading 24 hours a day at all, because there's not going to be a lot of volume in the market during the majority of the day. There's only going to be volume in the market during the trading sessions, and there's only going to be a lot of volume in the 2 major trading sessions. So you should really only be trying to trade during the trading sessions. But if you're a swing trader, then it kind of really doesn't matter. You're kind of looking to get in at specific levels and areas. Now, what is the best time to trade? So before that, let's look at how the 24-hour day looks like in the Forex market. So here are our 4 major trading sessions. 1, we have the Sydney session. 2, we have the Tokyo session. Then we have the London session. And then lastly, we have the New York session. So these are going to be our 4 main trading sessions. Now, session 3 and session 4, the London session and the New York session, are our biggest trading session. 41% of all foreign transactions happen during the London session, and then the rest happen through the New York session. Now, let's look at the timeline of when these sessions actually play out. So we're going to go based off this Eastern Standard Time Zone, right? So we have 1 a.m., then we have 12 p.m., or 12 a.m., and so on and so forth. So now when it comes down to the Sydney session, as you can see, normally it starts over here, which is going to be 5 p.m. and then ends around 1 a.m., where the Tokyo session starts around 9 p.m. and ends at about 3 a.m. And then London session starts at 3 a.m. and then ends at about 12 p.m. But as you can see, the New York session, the London session do cross over, which we'll get into that in a second, which starts at about 8 a.m. and ends at 5 p.m. being here. Now, this is going to be the timeline. If you want, you can print this out and save it. It's 1 a.m., 2 a.m., 3 a.m., 4 a.m., 5 a.m., 6 a.m., 7 a.m., 8 a.m., 9 a.m., 10 a.m., 11 a.m., 12 a.m., 1 p.m., 2 p.m., 3 p.m., 4 p.m., 5 p.m., 6 p.m., 7 p.m., 8 p.m., 9 p.m., 10 p.m., 11 p.m., and then 12 p.m. Now, let's look at the trading sessions during a better, time zone. So the Sydney session opens up at 4 p.m. Eastern Standard Time, then ends at around 1 a.m., right? The Tokyo session opens up at 7 p.m., ends at about 4 a.m. The London session opens up at 3 a.m., ends at around 11 a.m., and the New York session starts at around 8 a.m. and ends at around 5 p.m. Now, it doesn't mean there's always going to be volatility throughout the entire session. Typically, there's going to be the most volume within the first 4 hours of the session before it starts slowing down. Now, don't forget daylight savings. In the months of October and November, plus March and April, some countries like the United States, the United Kingdom, and Australia shift either to or from daylight savings time. So now let's look at the overlaps in the trading session. Notice how in between each Forex trading session, there is a period of time where 2 sessions are open at the same exact time. During these, what we call them are crossovers, is where you're going to see way more volume in these crossovers because 2 trading sessions are active at the same time. Now, Here is the first crossover or the first overlap, which is going to be the Tokyo and London session, which starts at 3 a.m., which you're going to see a lot of volume come in the market, and you're going to see a lot of movement. The second overlap, which is our biggest overlap, which this is our most traded session, is going to be the London session and the London and New York session crossover, which is around 8 a.m. to normally it's about 12 p.m. This is when after 12 p.m. the market typically tends to die off, but 8 a.m. to 11 p.m. Now you got to remember, 3 a.m. in London is 8 a.m. So that's when the banks are going to be open there. Then the trading session starts, and people tend to go to lunch and then come back for the New York session, which starts at 8 a.m. Eastern time. That is going to be the second overlap. Then the third overlap is going to be the Sydney and Tokyo overlap, which starts here. When the Sydney session and Tokyo session actually starts, that's when they typically tend to merge. Now, naturally, these are the busiest times during the day because there is more volume since the two markets open at the same time. Like I said previously, that's when you're going to see the most volume come in. This is typically when day traders and scalpers are looking to take positions if they haven't already, or are just manually watching their trades. So let's take a look at the average pip movement during each trading session. So this is going to be how much each market moves in terms of pips. This is going to be the average, right, during the Tokyo and the London session. Now, the first thing you're going to notice is typically the London session is going to have the biggest pip movements for these currency pairs. Now, if we look at Euro USD during the Tokyo session, we have a 76 pip movement on average. New York is 92 pips, and then London is going to be 114 pips. So as you can see, Euro USD tells you the average pip movement for Euro USD is going to be London session. That should tell you if you want to catch the biggest moves for Euro USD, that's going to happen during the London session. Now, if we look at GBP USD, we look at the Tokyo session. Tokyo session on average, GBP USD moves 92 pips, New York session 99 pips, and then London session 129 pips. Now, if we look at USD JPY, right, not much movement in the pair compared to these other two pairs, right? But USD JPY during the Tokyo session moves roughly 51 pips, New York moves 59 pips, and the London session moves 66 pips. If you look at the patterns in this pair, you could see that most of the biggest moves happen during the London session. And this is why sometimes I prefer to just trade the London session. Now, if we look at AUD USD during the Tokyo session, it moves on average 77 pips. It moves on average 81 pips during the New York and 83 during the London session. Now, this doesn't mean that you're going to have this type of movement every single day, but this is just on average when the market conditions are actually trending, right? Now, if we check out NZD USD, we see that it moves on average 62 pips. New York moves on average 70 pips, and London moves on average 72 pips. Now, if we look at USD CAD, on average for the Tokyo session, it moves 57 pips. New York 96 pips, and London normally 96 pips. Then if we look at USD CHF, it moves on average during the Tokyo session 67 pips, then 83 pips for the New York, then 102 pips for the London session. Now, let's look at the trading sessions average pip movement, and notice again that the London session provides the most movement. This is when you're going to see the most volume in the market. Now remember, these are our more major currency pairs, right? Now, when can you trade the Tokyo session, right? Traders that live in America, the trading day actually begins on Sunday night at 5 p.m. EST. However, it takes a few hours for liquidity to show up during the Tokyo session, right? Now, key things to know about the Tokyo session. The main participants during the Tokyo session are commercial companies and central banks. Japan's economy is heavily export dependent, therefore China is also a major trade player in the Tokyo session, hence the name Tokyo session. Occasionally, liquidity can be very thin at times. This is kind of pretty normal during the Tokyo session. It's not going to be every single day where you see big moves during the Tokyo session. This is why I personally don't trade the Tokyo session, right? But there will be times where you have to wait a long time to take a position during the Tokyo session. And sometimes when you take a position during the Tokyo session, it will play out during the London session. Now, moves in the Tokyo session could potentially set the tone for the day. Traders in the later trading session may refer to what happened during the Tokyo session. So when can you trade the London session, which is the session I personally trade? Traders that live in America, the London session opens up at 2 a.m. EST. This is pre-market hours. The actual open is going to be at 3 a.m. EST. Now, London is considered the center of Forex trading. London mainly benefits from its location and time zone. It's the morning's overlaps with the late trading during the Tokyo session, and London's afternoon overlaps with the New York session. This is why we typically tend to trade the London session. Key things to know about the London session, right? So, since the London session crosses with the other two major trading sessions, this results in a high liquidity and potentially lower transaction costs, meaning that spreads and commissions are going to be lower during the London session compared to, mainly spreads, but compared to the Tokyo session. Now, due to the large number of transactions that takes place, the London session is normally the most volatile session, meaning that you're going to see the most movement during the London session. Now, most trends will be beginning during the London session and will continue until the beginning of the New York session, where you may see a pullback from the trend, or you actually may see a continuation of the trend during New York. But typically, if one pair is trending during the London, then the New York is going to do almost the opposite. When can you actually trade the New York session, right? So traders that live here in the United States, the trading session for the New York session begins at 8 a.m. Eastern Standard Time. Now, key things to know about the New York session is that there is going to be high liquidity in the morning since it overlaps with the London session, which you're going to see again the most movement, right? Most economic reports are released near the start of the New York session. Remember, about 85% of all trades involve the US dollar, so whenever big time US economic news is announced, it affects the market, such as NFP, FOMC. These are all big news events that you want to try and avoid trading. When it comes down to news events and trading news events, it can definitely be seen as a very high risk thing because it kind of does whatever it wants. There's going to be a lot of manipulation during these major news events. Now, usually on Fridays, there's a chance of reversals in the second half of the session. So if you trade New York sessions, you kind of want to get in and out as fast as possible within the mornings, as US traders close their positions ahead of the weekend in order to limit exposure to any weekend news. So what session should you trade? You have to, one, look at your current lifestyle and if you're able to actually trade that specific session. So you got to look at your current lifestyle. Are you able to trade full-time or part-time? Which me personally, I only trade part-time, and then I work on everything else the rest of my day. So I really only trade the London session, and then that's it, right? I'm not actively trading London and New York session all the time, even though there are some days that I do. But I could be considered a full-time trader simply because this is what I do for a living. Now, once you identify the amount of time you could dedicate, then you could select which session you could focus on. Now, remember, this is key. Most liquidity is around the London and New York overlap, but prioritize fitting in which session fits your lifestyle. Keep that in mind. Now, managing your time, which is something that's super important when it comes down to trading, right? Just because the market is open 24 hours a day, it doesn't mean that you need to be in front of your monitor, your computer, every second of the day actively monitoring the charts. You need to set a time for your pre-market analysis, your active trading, and then you need to set a time where you're no longer trading and you're simply just reviewing how your trading day went to look to improve. Now remember, trading is all about balance and discipline in your life. You need to understand that when you actually need to trade the market and when you actually need to step away from the market. Because if you're constantly monitoring the market, you're simply just going to burn yourself out. You're going to fall into the effect of overanalyzing and overthinking, which can make you to cause poor decisions. And the more you stay during the market, the more it's going to affect you negatively. You need to find the right balance, which only comes with time and experience from when you're actively trading versus when you're kind of just, going to be doing your homework in the sense of, how your trading day went. Now let's go over a little bit of a recap for this session, right? So recap, the best time to trade. The best time to trade is when two sessions are overlapping. Typically, the London and New York session is the best time to trade. Or you could do the Tokyo to London overlap, but just keep in mind the biggest session is going to be the London to New York overlap, right? And the biggest session alone is going to be the London session. So when major news are announced, typically when major news is going to be announced, you do not want to be in a trade. You want to avoid being in a trade as best as possible because slippage can definitely occur along with a lot of market manipulation. And what slippage is basically let's say you set a stop loss at a certain price, meaning that if your stop loss gets hit, you're going to lose money. The news events can happen so fast that the brokerage can't fill your order in time to take you out of the position, and price will go even further than your stop loss. So what can happen is, let's say NFP hits, right, and price blows through your stop loss. Instead of you initially planning on losing $500, you lose $1,200, which is huge, right? Now, the London session is the busiest out of all of these sessions. If you cannot trade London, you can only trade New York. Don't worry about it. It doesn't really matter. What matters most is that you consistently show up and trade that session each and every day. Now, the middle of the week shows the most movement just because the liquidity is picking up. This is typically when you see the trend starting to play out and everything else. The beginning of the week, you could see more as like a pullback type of, thing. And then during the middle of the week is when you'll really see price start trending again and doing these really big moves. Now, these are the worst times to trade. The worst time to trade are Sundays when there's low volume, except for Sunday London session, obviously, because that's going to be your first trading day on Monday. That's going to be the Monday for the London people, right? Fridays, because this is when liquidity dies down as the New York session is closing for the weekend, and traders, banks, hedge funds are closing out of their positions. The holidays, because there's always going to be low volumes for the holidays, nobody's really trading, so you want to avoid trading during the holidays, which right now as I'm recording this video, we're going to be approaching Thanksgiving and Christmas and everything else, so volume is going to die down a lot. Major news, this can be a double-edged sword. A strong price movement, also quick reversal, so you have to be very cautious. Personally, I recommend you do not trade news. And the most important one is personal issues. If you're dealing with any personal problems in your life, you need to step away from the market. Maybe you had just broken up with your girlfriend and you may be a little bit depressed. You definitely don't want to be trading during these times in your life where you're going through it and you're very emotional and you're making a lot of decisions out of emotions. You're simply just going to be negatively affecting your trading account. Just take a break, and when things happen in your life, just understand you need to work towards making yourself feel better so you can come back to the markets and think as logically as possible. If you're fighting a lot with your family, that's going to cause stress on you. If things aren't going well at your job, that's going to cause stress on you. Don't look at the markets as a way to escape that, right? Sure, you could dive deeper in the markets and really start studying and backtesting, but don't trade live. I promise you're just going to be making mistakes. So when there's a lot of things in your life and you're really going through serious personal issues, now I'm not talking about you just got into a random fight, you know what I mean, with somebody, maybe an argument, and then you come onto the market and you just start trading, right? You want to avoid all that as best as possible. You want to actually trade when you're just thinking as logically as possible, especially when you're in a good mood and everything else. You're kind of you come to the markets with this mindset of, okay, I want to actually perform. That's all I wanted to cover in today's video. So hopefully you guys did understand the video. In the next video, we're going to go over what times you should trade. So there's going to be a part 2 to this. And hopefully, you can definitely benefit from both parts. So I'll talk to everybody in the next video. All right, so when we're talking about market sessions, this is going to be the time where you're going to be actively trading, right? So what we have to do is pick a session for you and what suits your current lifestyle, because you need to be able to show up to this session every single day and consistently trade this one session every single day. There's obviously your 3 major sessions, which are going to be your Asian session, your London session, and your New York session. Now, depending on the lifestyle that you live, depending on your current work schedule, potentially you need to be able to pick one of these sessions where you can show up to every single day and consistently trade this session every single day. You can definitely change it up later on in the future when you have potentially more time to dedicate to actually trading, and you do make trading a livable income, right? You could definitely change that later on. But as of right now, you need to pick a session that suits your current lifestyle. So what we're going to do now is we're going to hop on the computer, take a look at the market sessions chart, and then we're going to act out, or not act out, but we're going to kind of plan around how you could potentially make one of these sessions your sessions. Now, obviously, I'm going to be talking in a very broad spectrum because I don't know your current lifestyle and what type of life you live, what hours you're working, what hours you're off, whatever the case might be is, let's get into it. All right, so here we have a chart of the actual sessions themselves. This is going to be pretty much one of the bases that we're going to be adding to our trading plan later on in the future, but you want to take notes already on how you're going to be able to choose your market session. So let's kind of ignore the Sydney session for now because it's really not that important, right? What we're going to be focusing on is the Tokyo session, we're going to be focusing on the London session, and the New York session. So notice how we have the London and the New York session. These are going to be our two major sessions. This is where we're going to see most of the volume actually traded within the market. Now, 41% of all foreign transactions happen during the London session, and then the rest happens during the New York session, right? Now, so when it comes down to actually picking a session, you need to look at your current lifestyle. Let's go based off of somebody who works potentially, let's say, a 9-to-5 job, which should be the majority of people. So we know that we're going to be busy from 9 a.m. till 5 p.m. right? So trading New York session, let's put this in a perspective. Trading New York session is going to be a little bit more difficult. Now, if you're somebody who potentially works from home or you have access to a computer, it's possible. For your day traders and your swing traders, it's something that's definitely possible as well, because when we're coming into day trading, we're talking about day trading, we're looking at entering at specific levels, and what we could do is set alerts. Once price is at that level, we can maybe even monitor it from our phone and look and wait to take an entry from our phone, because the most important part is entering, setting your stop loss, setting your take profit, and then the rest from there, you're kind of just sitting on your hands. So if I were to be working a 9-to-5, right, this is how I would potentially do things if I was going to be trading the New York session, and maybe you can take your own notes and see how you can incorporate this into here, right? Now, theoretically, the best session to trade, in this situation, if you're trading a 9-to-5, would be the London session, where you would have to take a nap, but things would be very difficult there. So let's kind of focus on the New York session here. So you need to set a time to do your pre-market analysis. So from 7 a.m. to about 7:30 is where we're going to be doing our pre-market analysis. Now, we're going to be learning about all of this later on, but this is pretty much where we're going to be coming onto the chart, and we're going to be looking for a setup. We're going to be marking off the chart and waiting for what potential setups we could see, determining market direction overall, and then we're going to be getting ready to actually take the trade of the day. Here we're going to determine what type of risk we're going to be using on that trade. We're going to be determining the risk to reward ratio on the trade. We're going to be determining how big the move could potentially be. We're going to be reading price action, marking off our charts, and just performing technical analysis overall. Along with this 7 a.m. chart, 7 to 7:30 a.m. time frame, what you're going to be doing is your fundamental analysis as well, making sure that there's going to be no high impact news to interfere with your actual trade. So from 7 a.m. to 7:30, you're going to be actively monitoring or actively working on, reading the actual chart itself. Now from 7:45 a.m. till about, again, it's going to be very difficult because everybody's life is so different. Some people may actually have to be on their way to work at 7 a.m., but this is just how I would do things. From 7:45 a.m. to about 8 a.m., I already have my levels marked off, and I already know what I'm looking for, and I'm simply going to be waiting for my entry. So we're going to be actively monitoring from 7:45 a.m. till about 8:45 8:45 a.m., we're going to be looking for an entry. Now, this doesn't mean that if time passes 8:45 a.m., we're no longer looking for an entry, right? But let's just say we make our entry by then you can set your stop loss, then you can set your take profit. And day trading, you're typically trading based off of an hour time frame, based off a 30-minute time frame. What you could do is set an alarm every hour to just kind of check on the trade and monitor it, right? Or every 30 minutes if you want to be a little bit more on top of the trade, which I highly recommend, right? So we have our pre-market time, which is important. This is also important as well because we have to wait for our execution. But once we have our execution and we actually take the trade, we set our stop loss level, we set our take profit levels, and then we set an alarm for every 30-minute candle close. So if you take a trade at 9 a.m., right, you're going to be setting an alarm for 9:30 a.m., right, looking at the trade, checking the chart, seeing how price is moving, determining if you should continue to hold or determining if you should actually close, right? So now that that's done, right, we're pretty much done. Let's just say we're done for the day. You know, our trade hit stop loss, our trade hit take profit, whatever the case might be, is you needed time to come back into the market, right? And when it comes to day trading is what we're learning here. We're not learning scalping. Scalping, you have to literally be on your computer actively monitoring your trade, right? Because you're closing trades within minutes here. We're closing trades within 4, 5, 6 hour period, right? You know, my longest trade I ever ran was a few days, but you know, just kind of giving you guys the example here, your average trade, you know, day trading is probably going to last anywhere between 30 minutes to, you know, a few hours. Let's leave it at 8 hours, right? Sometimes your trades may roll over to the next day. But let's say you get out of work and, you know, your trade is done, you've hit your take profit, your stop loss has been hit, whatever the case might be, is you need a time where you can come back into your computer, journal, and look to see how, you know, you could involve yourself with doing your post-market analysis. So our post-market analysis is pretty much all we're simply doing is we're going to be reflecting on the previous day or on the previous trading day, or, you know, that current trading day, seeing on areas where you could improve, and, you know, taking journal of your actual trade, taking screenshots, and you're going to learn how to journal and everything else later on. But, you know, later on, once you actually get there, just come back to this video so you could incorporate this in your trading plan. So in this situation here, let's say it takes you 30 minutes to get home, right? We're going to be doing our post-market analysis at 6 p.m., right? This is where we're going to be pretty much planning for the day ahead and reflecting on the previous day. So let's say you're looking for a price to pull back into a level of structure to take a short, right? You're going to mark that off in your journal and you're going to plan for that day. So you already have it marked off, and in the morning you're going to see how the market's moved so far and if that trade you planned out previously is still valid. And that's simply all we're going to be doing, right? Now you need to choose one of these sessions. Now let me give you an example of how I do my London session, because I trade London session as of right now because my lifestyle allows me to. So my at 1 a.m. is typically when I come on the markets and I'm actively trading. So actually, you know what, let's start from 12 p.m. So 12 p.m. Eastern Standard Time, 3 hours before market open, is when I actually perform my pre-market analysis. So I'm going to put pre right here and then M for market analysis, MA. So 12 p.m. is when I'm doing my pre-market analysis. And again, this is for the London session, right? So I'm actively going to be trading from 3 a.m. till about midday. Right now, notice how this rolls over to the next day, because the London session and the New York session actually overlap. And this is when you're going to see the most volatility within the market. London session typically dies off around this time, around 5 a.m. and we won't really see much movement until about 8 a.m., 9 a.m. So, right. So 12 p.m. is when I'm performing my pre-market analysis. I'm performing my technical analysis. I'm reviewing to see if my previous trading day went well, how I can improve and make sure not to make those same mistakes on this trading day, along with checking up on yesterday's setup to see if it's currently playing out on today's trading day. Now from 1 a.m., what I'm doing is I'm actively trading, right? So I'm waiting for my position, I'm taking an entry, I'm moving stop losses. So from 1 a.m. forward till typically about 3 a.m., I'm looking for an entry in the market because I already have a hypothesis on where the market direction is going to head, and all I'm simply doing is waiting for my entry. I'm like a sniper hiding in the bush, just simply waiting to pull the trigger on my trade. I already know where my stop loss is going. I already know where I'm going to get out if I'm wrong. I already know where I'm going to get out if I'm right. And it's literally that simple, from 1 a.m. to 3 a.m. And then from there, I'm just constantly actively monitoring my position. So that's how I actively trade so far. Now, when it comes to me doing my post-market analysis, I actually do my post-market analysis whenever I wake up. Typically around 6 p.m. is when I do my post-market analysis. So let's just do post-MA market analysis. So hopefully you guys got a gist or a grasp of how you could pick your trading session. Again, it all depends on your lifestyle. You know, if you have a 9 to 5 and you want to trade London session, you know, and your sleeping schedule can allow it, go for it. Again, but you have to pick that one session and just consistently trade that one session. So hopefully you guys did benefit off of this video. Hopefully, you know, you make the right decision on your session, because you do need enough sleep to actively, you know, perform in the markets, because this is, you know, a very stressful and, you know, mind-numbing career. So, you know, typically from, you know, 10 p.m. to 12 p.m. I take a little bit of a nap. I do also make sure I get a minimum of 6 hours of sleep before I actually start trading. So, or at least 6 hours of sleep within that day. Typically 8 hours. I allow my body to get 8 hours of sleep just so I'm fully aware, alert, and I'm, you know, making the most logical decisions as possible. So, anyways, I will see you in the next video.